Hi, I'm Tom Stevenson, and welcome to Construction Business Management. We're continuing our studies on the financial statements involved in running a successful construction business. So, in this segment of the course, we're going to be looking at cash flow and discussing how cash flow integrates with the balance sheet and the income statement. But maybe before we start, we'll do a little quick review of some of the things that we looked at from the previous videos. And if you haven't seen the previous videos yet, I suggest you look at the descriptions below and I'll provide some links to them as well. If you click subscribe and look under the Construction Business Management playlist, you can see all the videos in the series. Okay, so in the previous video, we looked at gross margin percentage, how that can be useful, what it is, and we discussed that it's really a percentage of the overall sales that you have in your construction business. So it gives you a good indicator of how much of your business is being utilized with overhead and profit, and how much tends to go towards your direct job costs. We also looked at markup, and we discussed what exactly is markup. And markup is how much you multiply. It's the multiplier of your direct job costs. So if you're in the construction business and you've done your takeoffs and your estimates of what things are going to cost, well, then you have to also account for all of your overhead and profit. So markup gives you the indicator of what you need to do to multiply that core number by, so that you cover off your overhead, your office, your estimators costs, all the things that aren't directly related to that project, depreciation of vehicles, all of those things, and the desired profit that you're after. If you don't target these things and you don't account for them, you end up working for nothing, basically. And anybody that starts a business, you don't want to be just recouping direct job costs. Like, you might as well just work for somebody else if that's the case, and it's not sustainable. So that's the difference. Now, the difference between the two, because people often ask, well, what's the difference between the two? I don't visualize it. Well, one is a percentage of the total of your sales. So that would be your gross margin percentage. How much is going towards overhead and profit? The other is, what do I need to multiply my direct job costs by to get my sale price? That is the markup. Okay, but I get into a lot of detail in the previous video, so you can jump into that. We also looked at the break-even point. That's the formula for break-even point, but there's a few other steps you have to do to figure out when in the year do we break even. At what point in the year do we actually have we paid for the overhead that we're going to incur during that year? Because from that point forward, then really we're taking care of our job costs and our profit. So it's good to look at that and see if a trend is forming year to year, if there's changes that are occurring. Like if your break-even point's occurring later in the year, the next year and the year after, then you got to start asking yourself, why is there this trend taking place? So you can go back and check those videos. As I said, today we're going to be looking at cash flow and current earnings and managing cash flow. And cash flow is something that makes or breaks construction businesses. We deal in large sums of money. And if we don't get a grip on the flow of that money, we're not going to have enough money to pay our suppliers. We're not going to have enough money to pay our trade partners. And that's going to be problematic. We won't be able to continue the business. Even if we have profitable projects, if we mismanage cash flow, we will run into problems. We will have banks after us. We won't have big enough lines of credit to be able to pay who we need to pay. We'll run short of cash and the business will cease to exist. It'll grind to a halt. Our assets will be seized, etc., etc. So we definitely want to look after our cash flow. And part of the aspect of cash flow, usually cash flow is taken over a period of time like a year. You can review your cash flow for the upcoming year based on projects maybe that you've already procured and that you expect to procure. Some of it's estimates, some of it is pretty easy to actually foresee because there's certain elements. We talked about overhead. You have to pay the rent every month. You have to pay the cell phone bill every month. You have to pay for the truck every month. Those ones are pretty steady and established, and you can break that up into payments, monthly payments. going forward over the next year. What's a lot more variable is your projects and the direct costs that are going out to your projects. So you really have to look at, what are we doing in the next year? If you're a custom home builder, for example, and you plan to build a house, you can really sort of map out with your scheduling software when costs are going to occur, and you can see when those costs are going to occur and how you're going to pay that money out. And then you can also look at, how's the money going to come in? Are we going to get deposits? Is this a custom house that we're building for somebody? They purchased the land and they're paying us as we do the work. So how are we matching the money that's coming in with the money that's going out? If we're building a house on speculation, meaning we haven't sold it yet, there's going to be a lot more money that's going out than coming in. In fact, it's all going to be going out. So we better make sure that we have enough financing in place and enough cash in place to see us through till we actually sell and close the house. If we don't, then we're going to get the house 3/4 built and bank or somebody's going to seize it and sell it off. And that's obviously something that we don't want to occur. So we want to develop a cash flow statement that looks 1 year out. Now we've discussed in the previous lectures, the income statements and how they can project money going out a number of years in advance. We would definitely want to, and usually, in a business plan, when you're developing a business plan, it might be for 3 to 5 years out, those projections. Same thing goes with the balance sheet, and we've discussed the balance sheet and how the balance sheet must always balance. So assets have to equal liabilities plus shareholders' equity. So we would also have that projected out 3 years if we're projecting out the income statement. This one only shows 1 year, but we would have it projected out 3 years. There's also a connection point that takes place between the various statements, including the cash flow statement. So if we look at 2021, this is January 1st to December 31st, over a period of time. At the end of December 31st, our net income for the year over that period was $46,500. So that would then be our current earnings. So that would be under the line current earnings for our balance sheet, which has taken place on a point in time. So on December 31st, 2021, the end of this period, right? 2021, that would be our current earnings. That would be our $46,500. Our retained earnings from previous years, money that we've left in the business, is $30,000. And we actually had $100, I guess, just as a token when we started the business. So if we add that up, our shareholders' equity is at $76,600 shown on the balance sheet, right? Shown on the balance sheet. Now, cash flow statement is the measurement of all the money that is coming in and the money that is going out, and it's looking at what the difference is. It's also looking at how much cash did we have at a certain point in time. So if we look at this balance sheet over here, there's another connection. This is showing that we have cash on December 31st in the bank of $152,800. So let's assume it's end of day, December 31st, 2021. We have $152,800. This is going to connect to our opening cash flow for January 1st, 2022. Because if we have that much cash, liquidity, that's what we'll be looking at. And cash flow looks at cash. It doesn't look at accounts receivable. It doesn't look at work in progress. It looks at cash. Cash is king. If we need to pay somebody, who can we pay it to quickly? So cash flow statements review liquidity and your ability to pay things, right? So it records only cash payments and receipts, only the flow of cash. And that's following generally accepted accounting principles or GAAP. You require balance sheet, right? Like I just showed you. So you can, or the opening balance sheet, you need to know what your starting cash position is. Projected income statement. And an estimate of the timing of all the transactions. So you'd be looking at, if you're projecting that you're going to have this much sales in 2022, you would be breaking that up for that example. Now, if we started out to build a cash flow statement, we would be looking, and we're basing it on this, we would be basing it on the sales that we're expecting, the spreading of the job costs over the year. If we're very seasonal and we expect to be doing all the work in the summer, it may be concentrated over the summer. If it's fairly even over the year, maybe you're a small renovation contractor and you spread it out, or maybe you're a consultant and you spread it out fairly evenly over the year, then that may be. Or if it's concentrated, you put it where you feel it's going to occur. Then, of course, as I said, the overhead expenses, we can divide those up pretty evenly. You know, if we know that we're going to pay a property tax, or if we know that we're going to pay something on a certain date, then we could definitely, when we put it into our cash flow, not show it through the year and just put it in what month we know we're going to pay it. So, for example, if you pay your car insurance in one lump sum in July, well, then in July, you would put that one lump sum if you know that. If you spread it monthly over the year, then you would spread it monthly over the year. The idea is that you would see if there is going to be a shortfall at any one point. So this amount, that $152,800, this would be coming into the cash flow statement here. I think I've got the wrong year there, but I would have had 2022. So January 1st, 2022. Imagine that that's there in this case. Then we would be putting our expected inflows of cash. That would be the revenue that's going to come in. So total cash received during January. That's our expectation. And then we would look at the disbursements, the money that we expect that would go out during that month. So we would have our opening balance, and then we'd have the money that we would expect to leave. So maybe payments to subcontractors, direct payment costs, etc., job costs, and overhead costs. This could be much more detailed. I'm just giving you this as an example, but it gives you a good sense that you're measuring what's coming in against what's going out and what was your starting amount. So you started with $152,800. During the month, $85,000, $73,000. In a spreadsheet, it's easy to set up, right? So the difference between $85,000 and $73,000, so the difference is $11,000. You had $11,708 more come in than went out. So that's a good thing, because that is going to add to this, and now you've got $164,508. So you have more money at the end of the month than you started the month. So then that, you know what? This amount then becomes the starting amount for February 1st. So imagine this is at midnight on January 31st, and then this is February 1st at 1 second after midnight. So we keep it the same, and then that's your starting position. Then again, what came in, what went out? And again, now it's 27,000 more, so it's growing. But you have to understand, on projects, it's very possible that you could have a lot more money that's flowing out than's coming in. And there's a lot of reasons for that. I'm going to do another case study later and show you in the case study how you can be in a pretty negative position for most of the project before it turns profitable. For example, there's holdback amounts of money that you're supposed to hold back from your trades, but also the client holds back from you. Did you manage that effectively? If there's a shortfall, it's very difficult to be ahead in the money that's coming in and the money that's flowing out. You have to realize that if I'm a client, I really don't want to pay you more than the work you've done. So if anything, I'm going to probably be on the low side than on the high side in the progress payments. If a consultant's reviewing the progress payments that you put in, they're going to scrutinize it very carefully. So your goal, obviously, though, is to ensure that you're not putting yourself in a negative position. Now, you might have some very viable projects, and you could have a multitude of projects that is kind of the perfect storm. They're good projects, they're profitable projects, but there's a lot of money going out, say, in August. Well, you would see this if you're projecting this ahead of time, and then you could take actions to make sure if there's a shortfall that you have enough money. For example, if this was going negative in August, you could make sure that you have a line of credit that would more than cover that amount. And I say more than cover that amount because you better leave yourself a buffer. You don't want to go down to your last penny, and then if somebody delays paying you, the house of cards falls down. You definitely want to have a large contingency buffer in those cases. But you're effectively managing that ahead of time. You're looking at your cash flow, you're projecting it out. And if 6 months down the road, it looks like you're going to have a shortfall, well, then you can go after the financing today. You can put together the updated business plan. You can talk to your financial advisor, your bank. You can get approval to up your line of credit from, 1 million to 1.5 million, whatever that may be. And you're presenting that you have a viable business model. And if you're able to do that, and you've got a good reputation and you've been dealing with that bank for a while, it's not too difficult. On the other hand, if you show up in the bank in the middle of August, like a deer in the headlights, I need the money by Friday or I can't pay my people. Well, if I'm the bank, I'm kind of thinking, I don't know if you know how to, you don't seem too organized. You seem desperate. Why are you desperate? What have you done? Or what have you not done? I think we'll take a pass on upping your line of credit. You don't come across as being professional, organized. You come across as being professional, organized. You have a plan in place. It's a profitable plan. That's what banks are in business for. They'll loan money. Well, they get interest from you, right? They don't want to turn everybody down. They don't want to turn viable businesses down, but they do want to turn down risky businesses because it makes their business risky. So a cash flow statement, cash is king. Now, you have to also think about businesses, right? When we talk about construction businesses, the best and brightest construction development businesses in the world, very often they've gone bankrupt during a financial crisis, as an example. There was a number of them that went bankrupt in 2008. There was a number of them that went bankrupt in the early 1990s. Very smart companies, but they were leveraged and they had a financial model, and things changed enough in the external environment that it went outside their predictions, their risk assessments of the financial model, and they ran short of cash. And it put them into a financial tailspin. And they lost the trust of the vendor, of their banks, because there was an economic crisis going on. The banks had their own issues going on. So it's not so easy to access capital during those runs on the banks, so to speak. You have to have a good financial model, and you have to know what the risks are, particularly when you're leveraging. When you're leveraging, that can be a good thing, but it can also be a negative thing. I'm also going to do a case on house development and home development in this course too, so you can get an idea. There's a lot of advantages to return on investment with leveraging, so that's why it happens, but there's also a lot of risk involved with it. And if you fall outside your model, then you don't have the cash flow to pay your trades, your employees. I don't know too many employees that continue to work for their employer when they're not getting paid, right? Doesn't last too long. They start looking for other jobs very quickly. You lose your best and brightest very quickly. Trades are not going to continue to work for you if you're not paying on your progress billing requirements. There'll be liens, there'll be client issues, and as I said, the house of cards begins to fall. So cash flow is important for those reasons. Now, if you stay on top of these things, then that can be helpful. And also, running a viable business means you have to do more than just the work. You have to actively go after your payments. You have to make your progress payments, your invoicing on a timely basis. You have to be going after those progress draws. You can't sort of slack off on that because you're working in the business instead of on the business, because there will be no business. So that's part of that process. You have to be really sort of focused in on that. And, larger companies, it's not a problem. As the larger companies become larger, they will have somebody that will be, their job is to go after accounts payable and go after accounts receivable, to make sure that they're getting paid on time. Because everybody always gives the same line, the check's in the mail, or, oh, I didn't realize it was so important, or so needed to be paid so quickly. It sits on somebody's desk. If you do a lot of government work in construction, you deal with companies and bureaucracies sometimes it takes a long time to get paid. So you have to have a good understanding of how long it's going to take, and you have to make sure that you follow up on these things. And accounts payable, you have to pay your trades. Now, you can try to negotiate longer terms, and I'll talk a little bit about that when we come to an upcoming case on cash flow that I want to go through with you on a strip mall. It's kind of just how it was constructed and some of the things that you need to think about and get you thinking along those lines. But the cash flow statement, we have to be thinking about the breakout, and it's really looking at, well, what's the money that we're receiving? What's the money we're paying out? What did we start with? What are we left with? And what we're left with, that becomes then the starting cash flow for the next month. And then we go through the same process all the way through. We could see if there's a trend. Is it going up or is it going down? You know, if we see that this goes from 191 to 160 to 110 to 90 to 60 to 40, you see a definite trend. You want to look at your projects. Is this got to do with the amount of work that we're doing, the amount of money that we're collecting? We're not going after it. Is somebody not paying us? Are these projects viable? Are they not? It's an indicator of a lot of information. But as I've said before, like my mother-in-law says, no money, no funny. And I guess there's a lot of truth in that. No money, no funny. So I'm Tom Stevenson, wishing you a wonderful day. And hopefully this introduction to cash flow is helpful. And please click subscribe. You can see under the playlist for Construction Business Management the other videos in this series. And if this seems a little confusing to you, you might want to go back a few videos so you can start looking at the income statement and the balance sheet, because this basically forms part of, I guess you say, the trifecta of financial statements. And in the upcoming video, we're going to look at financial ratios and how those impact projects. We're also going to look at a couple of financial statement cases and interpretations. Okay, so again, Tom Stevenson, wishing you a wonderful day, and we'll see you next time. Bye for now.